If you go through any rich list over time, the top 100 or 500 richest people in the country, you will find that most of them would have made majority of their wealth through real estate. What makes them different to everyone else? What separates the average investor from the pros? The most important thing is timing. Things change all the time. The old theory, buying boom and buying gloom, works most of the time. And be cashed up for the next opportunity. For example, I've worked with many clients over the last 35, 40 years. Some have been great returns on their investments. Great buys. For example, one client was cashed up all the time. What he did is always had a spare $5, $10 million in his back pocket, which is not very common. And what he'd do, he'd wait till the opportunity came, the market lower and lower, properties sitting there, no one wanted to borrow, a situation where you can negotiate quickly and buy them. They'll be half vacant and make sure he's covered his basic expenses. Wait and wait. Didn't take long, 2-3 years, because he wasn't paying interest because he was cashed up. And then after 2-3 years, the market will pick up and he sold it. Rinse and repeat again. Another time he bought a motel on the market for a while. The guy was getting desperate. The owners, they were going for a divorce. When people look at buying properties like motels and hotels, their accountants and their surveyor and their architects and their lawyers and their finance people, and they wanted accounts and engineering reports and that sort of thing. He took the risk. He knew the situation, went in there with a cash bid, and purchased it at a really good price. He probably made about $1 million to $2 million for 12 months by reselling at a later date. Another situation, this person was an office block, wasn't doing very well, vacant, difficult to find tenants, wrong side of the street, wasn't the flavor of the month to buy. There was a hotel closing down. The Hilton Hotel was closing down, and they were refurbishing their rooms and decided to buy the furniture. Set up a boarding type of house situation, remained as a boarding house for ages. Sold it 2 years later at a profit. Now it's a development site. So basically, they had the ability of holding onto properties, weathering the storm, the downturns as well. Now the situation is distinct from residential. Residential have got 6, 12-month leases, whereas commercial have got 4, 8, 10, 20-year leases. Recessions don't last very long, 2-3 years. Now, if you've a 10-year lease, most companies weather the storm, or you negotiate with the tenants to stay there. And when things get well, you can negotiate a higher rental. It's a two-way win-win situation. During the property recession in the late 90s, portfolio, 100 properties. And what I did is that I kept my ear to the ground. I knew the market very well because I specialised in a special area, whereas the other landlords were charging or trying to charge or asking for a rent they were getting a year or two previously. I negotiated, sometimes 30-40% discount, whereas the average occupancy level was about 50%. We rarely got below 95%. And what happened? Okay, we weren't getting as much return before. When the recession was on, we were charging less for our rents. When the market picked up, we had well-performed properties. And some became sites. Some they kept for years and sold for 5-10 times initial purchase price. Timing. So the upside. What are the upsides in the area? Maybe there's a change of demographics. Maybe you can reposition properties for other demand. Refurbish, attract a new tenant. So the changes in how rents are going. And there could be situations where some landlords charge low rental. See a good example. I knew of a business, it happens quite often, they're looking to sell very quickly. They wanted a certain price, as like sellers want a certain price for their business to get it quickly. And they also the property. Now, usually a situation where you charge more to get lower price for your business and more for the business, vice versa. So what they did, they obviously got the right price they wanted for the business, and they gave them like a 5-year lease, I think it was, for the property. And I would say approximately 50%, 40% below market value. 2-3 years later, property was sold. Now, initially, it sold return on what their rental was. The person who bought it knew the rentals were below market value, and could put the cap, say the prevailing cap rate was, say, 4 or 5% at the time. They purchased it something like a lower cap rate, which looked pretty bad. A good deal for the owner, but it's for low. So what they did, they increased the rents. That cap rate went from the 3-4% up to about 7% because they were charging the market rental for that property. It's just a matter of interest. That was an industrial property too, which wasn't the flavour of the month. Now with the situation with the increase of online shopping, it'd be worth a lot more. So know the changes. Keep your ear to the ground. Know the market rentals, undercharging, overcharge. There's reasons for each development site. Has it been changed to a high floor space ratio, a greater height limit? Things sometimes are not what they appear to be on the surface. Look beneath the surface. That's what the pros do. They spend a lot of time looking at these things. We go through things with a fine tooth, the zonings, the changes in the demographics, all these sort of things. Markets change all the time. Of course, they take risks, and of course, sometimes they are wrong. But in the long term, they succeed. Property investment should not be taken lightly. It requires research and working with the right people to ensure that you're buying at the best possible time. Take advantage of the up times, the highest capital. Comments. Subscribe to this channel. This is Contacetus from CST Properties.